This LOS is explain the relationships between monetary policy and economic growth, inflation, interest, and exchange rates. Monetary policy. The ultimate challenge for central banks as they try to manipulate the supply of money to influence the economy is that they cannot control the amount of money that households and corporations put in banks on deposit, nor can they easily control the willingness of banks to create money by expanding credit. Taken together, this also means that they cannot always control the money supply. Therefore, there are definite limits to the power of monetary policy. The concept of money neutrality is usually interpreted as meaning that money cannot influence the real economy in the long run. However, by setting of its policy rate, a central bank hopes to influence the real economy via the policy's rate's impact on other market interest rates, asset prices, the exchange rate, and the expectations of economic agents. Inflation targeting is the most common monetary policy, although exchange rate targeting is also used, particularly in developing economies. Quantitative easing attempts to spur aggregate demand by drastically increasing the money supply. We'll do a few quick practice questions to finish this LOS. The first one is central banks' repeated open market purchases of government bonds, A, decreases the money supply, B, is prohibited in most countries, or C, is consistent with an expansionary monetary policy. C is correct. The purchase of government bonds via open market operations increases banking reserves and the money supply. It is consistent with an expansionary monetary policy. Another quick practice question. If an economy's trend GDP growth rate is 3% and its central bank has a 2% inflation target, which policy rate is most consistent with an expansionary monetary policy? A, 4%, B, 5%, or C, 6%? Okay, A is correct. This one shouldn't be too difficult. The neutral rate of interest, which in this example is 5%, you just take the 3% plus the 2% inflation target, is considered to be that rate of interest that neither spurs on nor slows down the underlying economy. As such, when policy rates are above the neutral rate, monetary policy is contractionary because it's making it more expensive to borrow money. When they are below the neutral rate, monetary policy is expansionary because it's cheaper to borrow money. It comprises two components: the real trend rate of growth in the underlying economy, in this example 3%, and the long run expected inflation, in this example 2%. So a pretty easy question. Another quick practice question. An increase in a central bank's policy rate might be expected to reduce inflationary pressures by A, reducing consumer demand, B, reducing the foreign exchange value of the currency, or C, driving up asset prices, leading to an increase in personal sector wealth. Okay, this is a good question, and I copy and pasted the transmission mechanism again because this question relates to the previous LOS with regards to the transmission mechanism. So A is correct. If an increase in the central bank's policy rate is successfully transmitted via the money markets to other parts of the financial sector, consumer demand might decline as the rate of interest on mortgages and other credit rises. This decline in consumer demand should, all other things being equal, and amongst other effects, lead to a reduction in upward pressure on consumer prices. So A is correct. Reducing the value of the foreign exchange currency? No, when they increase the policy rate, that's going to attract money. It's going to increase it creates demand. It's going to appreciate the currency. And driving up asset prices, leading to an increase in personal sector wealth? No, you've made it more expensive to borrow. Why would housing prices go up, for example? So a nice little question. And one last practice question to finish this LOS. Which of the following statements best describes a fundamental limitation of monetary policy? Monetary policy is limited because central bankers A, cannot control the inflation rate perfectly, B, are appointed by politicians and therefore never truly independent, or C, cannot control the amount of money that economic agents put in banks, nor the willingness of banks to make loans. Well, I think that was an easy question. Nice to finish on an easy one. So C is correct. Central bankers do not control the decisions of individuals and banks that can influence the money creation process. And that's the last slide for this LOS. Thank you.